A bank called her. Not the other way around. Not a robocall, not a credit card offer in the mail. A human being from Chase, on the phone, asking if she'd like to schedule a meeting to discuss her financial goals. Sonia had been a Chase customer for 11 years. In those 11 years, she'd never received a phone call from the bank that wasn't about a fraud alert or a late fee. She was the same person with the same social security number at the same address. The only thing that changed was a number on a screen. Her combined accounts at Chase had crossed $250,000, and the moment they did, the bank noticed. That's the video. 3 numbers, 3 tiers, 3 completely different experiences inside the same banking system, determined entirely by how much sits in the account. I'm Warren, and the thing about this topic that genuinely entertains me is how transparent the tiering system is once you know where to look. Banks publish their thresholds, they're not hidden. They're on the website, usually under a tab called something like Preferred Rewards or Private Client. And yet most people have no idea the tiers exist because nobody at the bank mentions them until the person crosses the line. The bank doesn't educate customers on how to qualify for better treatment. It waits until the customer qualifies and then rolls out the welcome mat. That's not a conspiracy. That's a business model built on asymmetric information, and the asymmetry is the entire point. Tier 1. $100,000 in combined deposits and investments at a single financial institution. This is the first threshold where the relationship changes. Below $100,000, a customer is a retail customer. Standard rates, standard fees, standard hold times on the phone. Above $100,000, the label changes. At Bank of America, this triggers Preferred Rewards Gold. At Chase, it qualifies a person for private client eligibility. At Fidelity and Schwab, it unlocks access to dedicated advisors and reduced fees on managed accounts. What actually changes at this level is less dramatic than it sounds, but more valuable than most people realize. Monthly maintenance fees disappear. ATM fee reimbursements appear. Savings account interest rates tick up slightly, usually by about 0.1%, which on $100,000 is roughly $100 a year. Credit card reward rates increase, and the biggest shift? Mortgage rates. A Preferred Rewards customer at Bank of America gets a rate reduction of roughly 0.25% on a mortgage. On a $300,000 loan over 30 years, 0.25% saves roughly $15,000 in total interest. The same house, the same income, the same credit score. Different rate because of where the money sits. Here's the part that should make you laugh in a dark sort of way. The fee structure below the threshold is designed to slow down the accumulation of wealth. Monthly maintenance fees of $12 to $15 a year add up to roughly $150. Overdraft fees average $35 each. ATM surcharges at out-of-network machines cost $3 to $5 per transaction. If you've ever been charged a fee for not having enough money in an account, that's the system working as designed. These fees disproportionately affect people with smaller balances, the exact people who can least afford them. And the moment those fees stop at the $100,000 mark, the person has already lost thousands over the preceding decade. The system charges admission until the person can afford to stop paying it, and then the charges vanish. That's elegant in a deeply cynical way. Think about it from the bank's perspective for a moment. A customer with $3,000 in checking generates revenue through fees, maintenance, overdraft, ATM surcharges, minimum balance penalties. A customer with $100,000 generates revenue through the use of their deposits. The bank lends that money at higher rates, invests it, and earns the spread. The first customer is profitable because of extraction. The second is profitable because of scale. The bank doesn't hate the first customer. It just doesn't need to be nice to them because the fees flow regardless. The second customer could leave, so the bank makes leaving uncomfortable by offering benefits that only exist inside the relationship. Waived fees, better rates, a dedicated phone line. The kindness isn't charity, it's retention strategy. And once you see it as retention, the whole tier system makes perfect sense. Sonia crossed Tier 1 at 32. She didn't notice. Nobody called, no notification. She found out 3 months later when she logged into the Chase app and saw a banner that said, "Congratulations, you qualify for Chase Private Client." She clicked it. The benefits page listed fee waivers, rate discounts, and access to a dedicated banker. She'd been eligible for 3 months without knowing it. The bank didn't rush to inform her. That 3-month delay is worth noting because it reveals the bank's posture. The benefits are available, but the bank doesn't proactively offer them. The customer has to discover them, and discovery favors the informed. Tier 2, $250,000 to $500,000. This is the range where the banking experience genuinely transforms. At Chase, Private Client requires $250,000 in combined deposits and investments, and the relationship includes a dedicated banker, priority phone lines, waived wire transfer fees, and access to investment products not available to standard clients. At Bank of America, Preferred Rewards Platinum kicks in at $100,000 and Diamond at $1 million, but the $250,000 range is where most banks shift from automated to human. The person gets a name, a phone number, a person who remembers their situation from the last call. The rate differences at this tier become significant. Mortgage rate discounts of up to 0.5% are common. Credit line increases happen without asking. Overdraft protection is automatic and free. And the bank begins offering products that aren't advertised publicly. Higher yield CDs available only to preferred clients, investment management at reduced fees, estate planning consultations bundled into the relationship. Sonia's call came at this level. $250. 11 years of banking, and the phone rang for the first time because a number on a screen passed a threshold. She took the meeting. The banker, whose name was James, sat across from her at a Chase branch in Scottsdale on a Tuesday afternoon. He had her account history pulled up before she sat down. He walked through her accounts with a level of attention she'd never experienced from a bank. He identified a savings account earning essentially nothing and moved it to a higher yield option available only to private client members. He adjusted her credit card to a premium tier with better rewards and no annual fee. He pre-approved her for a mortgage rate she hadn't known she could qualify for. The meeting took 45 minutes. It saved her roughly $8,000 over the following year in improved rates and eliminated fees. 45 minutes, $8,000, because a number crossed a line. Sonia said afterward that the strangest part wasn't the savings, it was the tone. James spoke to her like a colleague, not like a customer being processed, not like a number on a screen, like someone whose business the bank wanted to keep. She'd been a customer for 11 years, and this was the first time the bank had ever expressed interest in keeping her. Below $250, the relationship is transactional. Above it, the relationship becomes relational. Same bank, same person. Different number, different everything. The uncomfortable question is straightforward, and if you've been following the series, you already know where it leads. Why wasn't James available at $47,000? Why wasn't the higher yield savings option offered when Sonia deposited her emergency fund 3 years earlier? Why does the premium credit card only appear after the net worth crosses a threshold? The answer is resource allocation. The bank makes more money from high-balance clients and allocates more resources to retaining them. Low-balance clients are profitable through fees. High-balance clients are profitable through relationship. The bank optimizes for both, but the optimization produces two completely different customer experiences inside the same institution, using the same logo, the same app, and the same front door. Tier 3, $1 million and above. This is private banking, a different floor, sometimes a different building, sometimes a different entrance. At most major banks, the private banking threshold is $1 million in investable assets. Though some start at $500,000, JP Morgan Private Bank starts at $10 million. What changes at this level isn't just rates and fees, it's the nature of the relationship entirely. Private banking clients get access to alternative investments that aren't available through standard brokerage accounts, including private equity, hedge funds, and structured products. Tax planning becomes integrated with investment strategy, meaning the advisor and the accountant are in the same room, working from the same data. Estate planning attorneys are on retainer through the bank. Philanthropic advisory services help structure charitable giving for maximum tax benefit. And the lending products at this tier are genuinely different from anything available below. Securities-backed lines of credit where the portfolio itself serves as collateral for a loan at rates below the mortgage market. A person at Tier 3 can borrow against their investments at 3 or 4% instead of selling and triggering capital gains taxes at 15 or 20%. That's not a perk. That's a structural advantage that compounds over decades. There's a reason the wealthy pay lower effective tax rates than the middle class, and it's not complicated. It's access. Access to products, strategies, and structures that only become available after a certain number appears on the balance sheet. The tax code doesn't change based on net worth, but the tools available to navigate it do. Tier 3 is where those tools unlock. Most people watching this video aren't at Tier 3. That's fine. The point isn't to reach private banking status by next year. The point is to understand that the financial system has layers, and each layer offers a meaningfully different experience. A person at $47,000 and a person at $250,000 are using the same bank, but they're not living in the same financial universe. The products are different, the rates are different, the attention is different. And the gap between the two isn't just money. It's information, access, and compounding advantages that make the next tier easier to reach once the current one is crossed. Here's the protocol. Consolidation is the fastest lever. Most people have accounts spread across 3 or 4 institutions. A checking account at one bank, a savings account at another, a Roth IRA at a brokerage, a 401k at their employer's provider. Individually, none of these cross the threshold. Combined at a single institution, they might. Sonia consolidated her Chase checking, savings, and brokerage accounts. That consolidation, moving about $40,000 from an old Ally savings account and rolling an orphaned 401k from a previous employer into a Chase IRA, pushed her over the $100,000 line without adding a single new dollar. Same money, different address, different tier. The second lever is the employer 401k. At Fidelity and Schwab, the 401k balance counts toward the relationship total. Many people don't realize this because the 401k is managed through the employer portal, not the personal brokerage. But the balances aggregate. A person with $50,000 in a Fidelity Roth IRA and $60,000 in a Fidelity managed 401k is at $110,000. Tier 1, without knowing it, without being told. And that's the detail that captures the entire system in miniature. The tiers exist, the thresholds are published, the benefits are real and measurable. And the bank's primary strategy for managing them is silence. Not secrecy. Silence. The information is available, it's just not offered. The customer who finds it benefits. The customer who doesn't continues paying full price. Every video in this series has followed the same pattern. The rules exist, the math is public, and the advantage goes to whoever reads the fine print. Credit scoring in video 6, investment order in video 7, portfolio construction in video 10. And now banking tiers. The system doesn't hide the rules, it just doesn't announce them. If you've been banking at the same institution for years without ever checking the tier thresholds, the relationship summary page is the place to start. The number might already be there. And if it's not, now there's a target to aim for. Because every threshold in this series, from the first $10,000 in video 1 to the banking tiers in this video, shares the same property. The system changes the moment the number is crossed. Not before, not gradually. At the threshold. And the person who knows where the thresholds are reaches them faster than the person who doesn't. 3 milestones: 10,000, 100,000, 1 million. Each one changes not just the math, but the psychology, the behavior, and the identity of the person who crosses it. That's the next video. The milestone series starts now. Here's what to do with this information tonight. First, pull up the relationship summary at the primary bank. Every major institution has one, usually under account settings or relationship overview. It shows the combined balance across checking, savings, CDs, and investment accounts. Compare that number to the published tier thresholds on the bank's website. If the total is within 10 or 20,000 of a threshold, consolidation from another account could push it over. Second, check whether the employer's 401k is held at the same institution as the personal accounts. At Fidelity and Schwab, the 401k balance often counts toward the relationship total. A person with $50,000 in a personal Roth IRA and $60,000 in a Fidelity-managed 401k is at $110,000. Tier 1. Without knowing it, without being told. Third, if the balance is already over a threshold and no contact has been made, call the bank and ask. The benefits don't always activate automatically. Sometimes the customer has to request the upgrade. The bank won't volunteer that information either. The milestone series starts next.